Welcome to this month's Market Update. I'm chatting today with Casey Lowe, Senior Consultant from Frontier Advisors, Capital Markets and Asset Allocation Team. Hi Casey.
Wayne.
Now, while some of us at least were enjoying a Christmas vacation, you were hard at work on a research trip to China in the early part of this year. Tell us a little bit about some of your findings.
Yes, it was a busy start to the year. So I was over there attending a conference and I visited a couple of companies in the high-end manufacturing space as well. There's a lot I could talk about China, but I just want to focus on two key items today. So the first one is the ongoing deleveraging drive by the government. So the so-called reduction of financial risk. And the second item is this ongoing US-China trade tension. So having been on the ground, I can say that these two factors have negatively impacted on growth there, and it has slowed down actual business activity. You can see that in the numbers. So in terms of the external trade growth numbers, both import and export growth have started to slow down. And also in terms of domestic consumption growth, if you look at the retail numbers, in particularly the auto sales numbers, that has turned negative, which is the first time in several years that has happened. So both domestic and external growth drivers in China have slowed. Now the government have implemented some stimulus policy, and we're expecting more to be implemented, but it's unlikely to be large amounts of stimulus like we saw back in the 2016 slowdown, just because this time around the government is focused on this reduction of financial risk.
Sure. Okay, now moving to other parts of the globe, what should investors be looking at and thinking about at the moment?
So equity markets have increased in value since Christmas and over the January period. They did fall substantially from the late September peak to around mid-December, so it's about 15 to 20% fall, depending on which equity markets you looked at. But since then, Australian equities, developed market, emerging market equities in Australian dollar terms have increased in value, and they are actually now above where they were at the start of last year, so it's in positive territory again. Now, what has driven this positive sentiment? This has been, in our view, mainly driven by the US Federal Reserve's change in view. They've gone from one where they've been consistently increasing interest rates to one where they're more cautious now on raising rates further. You can see this reflected in their latest meeting announcement, where they kept the interest rate on hold in the US within the 2.25 to 2.5% band. So yes, we saw some equity risk later last year, but the Federal Reserve have responded to that now. Apart from that, there are other risks out there. So as I mentioned, Chinese growth slowing down. There's the ongoing trade tension with the trade truce deadline looming for 1st of March. And in Europe, we have the Brexit renegotiation. And just in general, this has been a very long cycle. So in the US, this is the second longest expansion that we've seen in history.
Right.
So there are some risks looming there, but US growth is still positive, so it's not all bad news.
Sure. And returning to our own domestic market here, what sort of things have got your eye on in the Australian economy and markets?
Yeah. So the Reserve Bank of Australia sort of followed in line with the change in view of the Federal Reserve. They did leave the cash rate on hold in their latest meeting in February, but the key thing to watch here is the change in messaging. So they've gone from one where it's a hiking bias, so leaning towards increasing interest rates, to one where it's a balanced view. So in Phil Lowe's, the Reserve Governor's own word, they can see scenarios where the cash rate goes up. They can also see scenarios where the cash rate goes down. So it's a balanced view. But definitely their view on the outlook has diminished a bit. If you look at the latest forecast for the Australian GDP number, economic growth number, that has come off from 3.25% to 3% for 2019. Now, you may ask, how can the Reserve Bank have a balanced view when house prices in Sydney and Melbourne have fallen around 10%? So the reason for that is there are still positive factors out there. So let me list out a few. First of all, government infrastructure spending that continues to grow. that is going to offset some of that slowdown in dwelling construction in the housing market. Business investment, that continues to grow as well, and the labor market is still very strong. So we added about 280,000 new jobs over the last 12 months, and the unemployment rate is around 5%, so quite low numbers there.
All right, thanks for that wrap up, KC, and thanks for watching this market update.